Good morning. Glad you are here today. Man, after the story told by Chris, man, it's hard to talk, Right? But let me try, about the head and the heart, I didn't do bungee jumping, because I know better, But, a similar story like him, to talk about sometimes you think you know, and you think that you can do it, but when you're making decision, the heart takes over. Okay? Now, I'll tell you a story. This is not exciting as bungee jumping, but I hired this assistant professor from UCLA, study under one of the smartest, behavioral finance professor out there. Right? And I studied under also, one fine day, I believe a professor of mine may win the Nobel Prize in economics. Right? So both of us were sitting there thinking that, man, both of us got PhD, right? We are very clever, right? We are very smart, like smart investing, right? So if me and this guy put our head together, we should be able to make some money, right? So what we did, we take our, models, take all the theories that we know, then we start formulating models, so then we start trading. When you walk into my this colleague's office, it looks like a war room, monitor everywhere, right? So we were crunching numbers every morning, 6 something. We will go into the office, waiting for the Nikkei market to open, and thinking that we will go for killing, okay? Right? Because our model say it works. We built our model. It's an order imbalance model, looking at the pressure in the market that's coming, right? The sellers and the buyers, like those who watch on TV, very exciting, So we tried that, right? Guess what? Right? On paper, the statistics and all the empirical evidence say that we should be able to make money, okay? But then again, we are the one our finger is on the keyboard doing the buy and the sell, okay? Then after a while, okay, the market start dropping, Our model say, buy, but the market stop dropping. So what do? The head says, don't worry, trust the model. But the heart say, scared lah, I don't want to jump. So ended up, didn't make money, but it was a really good exercise. It really, teach us a very important lessons, at least, from the standpoint that even though we do the research, even though we know a lot of things, even though sometimes our head tell us what to do, but the heart, So I think I've said this before in a forum like this, how do you succeed in the equity market? How do you succeed in this financial market? If you can train yourself, if you can speak Cantonese, mo yan sing, then until you become a robot, I think that's the time when you can make money. Okay, but so today we are going to talk about smart investing, talk about pitfalls. Right? Now, if you look at your booklet, right, one of the questions in there talk about expectations. That is a very important piece of question. I think it's question number 4. Realistic expectations. Right? Now, because we have to form expectation about a lot of things. One of the things that we form expectation about is basically how long you will last. When are you going to expire? Okay? Ask the insurance people, they take out a chart, they'll tell you, men on average expire at 81. Right? Women on average expire at 84. Right? So I was telling my colleague earlier that I'll celebrate, my birthday, right, when I'm 82. Right? Because I earn 1 year. Right? If I'm 83, then I put 2 candles because I earn 2 years. Right? Then sometimes you go to Sunday, you go out and people declare, I'm going to live to 120. Then I start, wow, are you sure? You last that long, your money can last or not? Right? So anyway, so knowing yourself is important. Forming expectation, thinking about your lifestyle and how long you're going to live, because all this have impact. Because you need to start early to plan for what's going to come next. Now, the other thing about expectation, I've said this before in a forum like this. I think we'll look at my old video. Sometimes I think this is that time of the year. You see a lot of praying. You see a lot of things, and normally people go and pray for what? pray for 4 numbers. Right? You come here also, I give you 4 numbers. Right? But unfortunately, my 4 number you cannot buy. Right? And those 4 numbers are numbers that you can use to form expectations. Right? Right? What's the first number? Right? The number 3. Okay? Number 3 is 3%. 3% is important because all these things you have to keep at the back of your head. And again, these are not things that you go out and say, hey, Prof, you're wrong. Right now the number says 2. No, these are long-term averages. Okay? Over the last 80 years of history in a developed economy. Okay? What is the expected inflation rate? It's around 3%. Okay? Keep that at the back of your head. Okay? So every time you turn around, chicken rice prices goes up by 3%. Right? So if you are going to plan for retirement 20, 30 years down the road, you have to understand that prices on average will creep up by 3%. So if you put all your dollar bills in a tin can and hide it under your bed, okay, at the end of the day you won't be able to afford those chicken rice, okay, because prices are going up every 3%. Right? Now, the other number I said the last time was 4%. 3 plus 1. So the plus 1 really tells you that is the compensation that the market will give you. Because I'm speaking very abstract, not like Chris. Chris will tell you, numbers. But I'm telling you how to think about this, how to think through this. So if inflation is 3%, if you want to lend money to somebody, definitely the somebody would have to pay you back to cover your inflation, right? Okay, if not, you'll be worse off. Okay. So the market, in some sense, is quite fair about this. So if you go and buy a risk-free type of a security on average, okay, I'm talking about average, okay, over the last 80 years, okay. So the average is around 4%, okay, and that 4% is a very important number. C, right? Easy to remember, right? And not a popular number among some people, okay, right? But that 4% basically tells you that if you were to invest in something that is risk-free or perceived to be risk-free, okay, and there's no such thing as risk-free, but almost risk-free, right, then the type of compensation that you'll be expecting should be around 4%. Okay? If somebody comes in and tell you that, wow, this thing has no risk, okay, they're very good investment. It's going to pay 12, 14, 15, 20%. Okay? Tell a very good story. You sit there, wow, you nod your head. Wow, they show you all the chart. Wow, if I buy here, I sell here, I buy here, I sell here, I buy here. Okay? Sell. No, I'm not the jumping in and out, but pretty much the same thing, right? Okay? So instead of jumping in and out, you're buying and selling, okay? Right? You're going to make 20%, 30%. Okay? But remember, if it's risk-free, right, the market will compensate you around 4%. Anything higher than that, right, they are not telling the truth. Okay? Right? And this is really smart investing. Be realistic. Know what are the numbers. Okay? And the third number that I gave the last time is the number 6. Okay? So we are 3, 4, 6. Right? So 6% is for what? That's additional 2% over the risk-free rate. That is your average return on your bond, your corporate bond. Your investment grade corporate bond on average. But then again, it all depends. If you are triple A bond, okay, you'll be lower. Double A bond will be higher. Single A bond will be even higher. And triple B, it gets up there. But once you cross the line into double B bond, become junk bond, then those things pay a lot. But then they are very risky. So when I say 6%, I'm referring to investment grade bond. Okay? So they're on 6%. So if you put in a corporate bond, on average, it should return you around 6%. Okay? Because they are, somewhat lower risk. Okay? Now, what's the fourth number? So what do you have now? 3, 4, 6. Okay? What's the fourth one? 10. I was going to say 9, but 3, 4, 6, 9, then people go and buy 4D, right? 10%. Okay? So 10% is the expectation you will have to form in your head, right, throughout the history of the stock market. If you put your money in the stock market, you hold it for 20, 30 years. Okay? You should expect a return of around 10%. If your expectation of investing in the stock market is minus 2%, will you put money in the stock market? Definitely not, right? You might as well put in a risk-free asset that pays 4%. Okay? Right? But if you were to look at the history of of the stock market over 80 years. Okay, right? The average is around 10%. Those S&P 500 type company. Okay. Now, having said all this, okay, right? You have to start thinking about planning. Okay? Decision making is actually very simple. Okay, you start with identifying your goal, establish all the criteria, right? Weigh the pro and the con, make a decision, and then evaluate. Financial is the same thing. Okay, you set goals, you analyze information, you create a plan, and the most important thing is to stick to the plan. Okay, stick to the plan. Okay, don't run in and out of the plan. Okay, jump in, jump out, jump in, jump out. Okay, never win. Okay, right? And this is what happens when people start jumping in and out. Right? When the market is going up, wow, people get overconfident, right? Okay? Because every other neighbor of yours is making money in the stock market. Okay? Just look at China. Okay? For a while, the market was really, really up. Okay? So it was going up, going up, going up. And suddenly it looks like, wow, it's going to go up forever. And greed kicks in. And people got greedy. Okay? Right? And then you buy some more. And then you see what happened. Okay? When you know, the men on the street are talking about nothing but the stock market, okay, I think it's time to sell. Okay? When everybody is, you know, throwing a long face about the market, losing money in the market, maybe it's time to buy. See? Right? Because what you want to do is to buy low and sell high, right? That's what they teach you in those how to make money classes. Okay? Very simple strategy. Buy low, sell high. Buy low, sell high. Okay? But human behavior is such that over here, you wait. Okay? And when everybody is buying, then the kiasu, you know, a person in you say, cannot lose out. Right? So you jump in. Right? And start buying. Okay? And not only you jump in, other people jump in too. Okay? So collectively we all jump. Right? And what happened to the prices when everybody start buying? It goes up, right? Okay? And then the market basically hit the top. Okay? And then suddenly they say, wow, this market, a little bit of bad news, then it triggers the fall. Right? When it falls, this is what happened. You know, people are in denial. Don't worry, okay? Right? I bought this stock, okay? It came down in prices. Don't worry, it will come back up again. Just hold, okay? Then it fall further, okay? Now you're shaking your head, especially, you know, right? All these are money that you need. You need the liquidity. So instead of putting it in the bond, you put it in stock. Yeah? And it's not that you can hold for 20 years, right? And then despair kicks in. And if it goes down some more, then you become really desperate. Then what do? You sell. Okay? Unfortunately, you're not the only one. There are a lot of people in the market that are in your same situation, right? And they all get desperate at the same time, and everybody starts selling. And what happened to prices? Go down. And they go down some more. Okay? Right? And after that, you say, well, I'm not going to touch this thing anymore. Right? Then the market turns. Okay? You know, then you tell yourself, this thing won't last, right? But then it goes up again. I say, wow, looks like it might last, you know, okay? And then by the time you jump in right here, and you're at the top again and waiting for another drop. So ended up, what do? Instead of buy low and sell high, you buy high and sell low, okay? And you repeat this again until what happened? Until you lose all your money, okay? Right? So going in and out of the market, you know, it's not for everybody. It is for some people. Some people really can do it. Okay? And who are these people? Those people with what? In Cantonese they say, 冇人性. Okay? So those people with no feelings, they can do it. Okay? Because it doesn't really affect them. There's no emotion. Okay? To them, all this dollar figure is just a number. So if you can train yourself to be emotionless, you know, yes, you can play this game. Okay? Yeah, I for sure cannot. Even though my model tells me that, you know, I should. Right? But the heart basically is too afraid, you know. Right? Okay. If not, I'll be a trader, you know. Right? Instead of telling stories, right? And working on research, Now, if you look at the number that I just gave you, those 3, 4, 6, and 10 business, okay, I'll take a few more minutes, okay, because between your tea break, okay, and you, it's basically me, okay, so I try not to get in your way, okay, but this is important, because if you look at some of the numbers, right, if you see exposed over here, this is what you measure after the fact. So after the fact, if you look at the numbers, these are some of the percentages that you see. Especially if you look at the stock indices these days, okay? You say, well, Prof, where's your 10%? Remember what I said about 10%? It is over the last 80 years, okay? Right? When you measure this stuff over the last few years, the number can be very different from your expectation, right? But if you form your expectation thinking that the stock market is only paying you 4.3%, come on, none of us will be buying stocks, okay? You're better off in buying bonds, okay? But see, that's the difference, you have to think of the concept of ex-post and ex-ante. Ex-post is after the fact. After the fact, these numbers can be anything, but if you take a very long horizon, okay, and what will happen is a lot of this bond yield and this stock return will be almost, following that 3, 4, 6, 10 business, 6 and 10, okay, right? So remember, ex-ante is the concept that before you buy, you are thinking about it, about what's going to happen in the future. Okay, this is ex-ante. And what's going to happen in the future over the next 80 years, okay, or 30 years, right? At least 20, 30 years, is really your 3, 4, 6, 10 business. Okay? Right? But after you go past 1, 2, 3 years, you look back over the last 3 years, that last 3 years can be anything. Okay? Right? So that's why I say you have to stick to your plan. Okay? Okay, now, so if you look at the US market and the Sing market, the next few slides are basically to show that there's a lot of parallel. And this is the equity market, and this is the bond market, and then this is basically the inflation rate. Okay? You notice that the world market kind of move in tandem. Right? But what is something I need to show you is this idea of volatility. Stock prices going up and down. One thing we observe in these days is that volatility has gone up. Okay? So when volatility gone up, what does it mean? When stock price goes up, it goes up a lot. When it drops a lot. Okay? But don't despair, okay? It's okay, you can ride the volatility, okay? Right? Volatility will make you do things like this, okay? Buy high and sell low, okay? Right? Because if it goes up, it looks like it's never going to stop going up, right? You ended up buying, and then when it start dropping, okay, and it drop a lot, then you get desperate, then you start selling. Okay, so the volatility, increased volatility in the market, you're looking at this chart, right? Basically, causes a lot of people to, in some sense, buy high and sell low. So how do you take care of all of this? Right? You take care of all of this by basically, following Chris's advice. Right? Have a good plan, go in there, stick to the plan, right? And build a diversified portfolio. Right? Right? And the risk basically is yourself. You just cannot control your heart. If you can control your heart, you can control your emotion, right? And you can solve a lot of this problem, right? So if you know that you have this problem, then basically stick to a very simple game. And what would the simple game be? And it turns out it is asset allocation. When you are young, you have the ability to take risk. You should be taking risk. Okay? Because if you look at the stock market over the long haul, it is around 10% return. Okay? Don't settle for anything less. But when you are slightly, mature, okay, closer to retirement, you cannot be aggressive. You need to be conservative. Okay? Because, over the span of the next 2-3 years, the equity market can be down 15%. Okay? Right? But over the long run, it will be up. Okay? Right? So it all depends on where you are in the spectrum, you see. Right? So if you have these accumulating years, okay, your planning horizon is more than 11 years, you really need to take, more risk and be exposed in the stock market. But when you're up here, right, in the spending stage, closer to retirement or at retirement, then basically hold a more towards cash type of a portfolio, right? Right. So asset allocation basically is the play, a very simple play. So you go from being young, right, taking a lot of risk, as you get to the golden years playing golf, okay, this is where you really want to be defensive. Okay, so you just balance your portfolio every 5 to 10 years, and don't worry about market going up or down. I think people should be fine. Okay, that's when Chris was talking about setting goals and all this, right? So, and this is another chart to show you the asset allocation over life. Okay, when you are 20-some years old, you need to be exposed to the stock market. Okay, and don't just buy one stock. When I say the stock market, I mean the market. So, well, Prof, I cannot afford to buy the whole market. Well, fortunately, these days there are ETFs. So you can basically own a bunch of ETFs, and then you can have a very well diversified portfolio here. But when you are getting up in your golden years, okay, right? But if you still like bond, then dabble in some. But most of your allocation should be in the bond market. And this is where the Singapore savings bond might come into play. Okay? Now, all these are all good advice. But the best advice I can give you is to basically say no to so-called investment that may turn out to be bad. One of the advice I always give in here is that if there's something that you don't understand, then you just stay away. Okay? Stick to the simple play. The simple play is basic asset allocation between bonds and stocks. Okay? And make sure that your insurance and your medical insurance and all these are covered. Okay? Yeah, then you should be fine. But really need to understand yourself. You have to know the product and know the strategy. And if it's too good to be true, it probably is. Okay? Right? That 3, 4, 6, 10 is a guide. If anybody tells you that investment is risk-free, right? The highest return that you should be expecting should be around 4%. Okay? If it's too good to be true, it probably is. Okay? There's no such thing as a free lunch in the market, right? So if you don't, if you are not cognizant of all this expectation, realistic expectation, after a while we are all human. The greed and kicks in, right? And then after, when the market turns like these days, the fear kicks in, and then you basically unload. Right? If you can do the opposite, it would be the best. When the market are all scared, you are the brave one. Right? When the market are really optimistic, then basically you fear. Then you are the contrarian, and that might work for your favor. But then again, this is what your head is thinking. Your heart may not be able to take it. Okay? Now, this chart is one of the most important slides. Right? If you get hold of this slide, blow it up, frame it, and put it in your bedroom and stare at it. Okay? This is really a return of all the different asset classes from 95 to 2014, and you notice that it is almost impossible to go and pick the winner. You see, you have sometimes the cash portfolio is down here, but on some really bad years, the cash portfolio is up there. See? Right? But if you notice the one in white is the one that Chris was alluding to just now, the well-diversified portfolio. It is always here. Okay? Right? So if you are not too greedy, you plan ahead, right? You have a well-diversified portfolio, and you notice that the well-diversified portfolio stays pretty up there. Okay? So what's the moral of the story? Right? Don't get greedy. Okay? Right? Set expectation and stick to the plan. Okay? Right? And don't believe, things that are too good to be true, and avoid scams. Okay? Right? Somebody tells you that this is a good deal. Like a while ago, we were talking about investing in gold. Right? Oh, gold pay interest. What rubbish is this? Gold pay interest. You have to find storage for gold. And storage is expensive. Go and try to rent a self storage and see what I mean. Right? Not only expensive. Your gold might disappear. Okay? If you store it over there. Okay? Right? So remember. Okay? If it's too good to be true. Okay? It is too good to be true. Okay? Thank you very much.